Hello there, fourth dimension trading time. This is an educational video on how I create the supports and resistances for the commentaries. So the principle is that I'm using the fourth dimension to create a third spatial visualization from a two-dimensional image. So I'm using multiple time frames on one picture. That's what that means. Consistent themes for traders: timing, location, time frame chart, conflicts, missing the opportunity, and screen real estate. So what is the solution? Got to get the correct trade location, quantify extremes, understand time and space, quantify divergence, and then put that into a multiple time frame analysis in one visualization or chart. And these principles apply to all markets and horizons. Let's be proactive, not reactive. So the first thing is why I use equalized active continuations, and this is very, very important. So we have a chart here, just a normal continuation chart on an interest rate, and when we have a rollover, there's a great big gap up and down, and so it actually looks like a potential island reversal, but it's just to do with the contract rollovers. And when we equalize the closes for each rollover, we have a completely different chart, and actually in classical terms it was a double top, so a massive difference. And unadjusted data has one set of absolute highs and lows, and they're never going to change. And when we do an equalized active continuation, they do adjust through time. So every time there's a rollover, those previous levels are going to move. So good example is oil last year, where the major levels have consistently fallen. So we must use active continuations because there is a closer correlation to the continuous contract. Significant support and resistance adjust through time, and it creates levels that are not obvious to the market or to other commentators. So we have true measures of support and resistance through multiple time frames, and this is what's called peak energy and peak expansion. Commentaries or analysis usually just reference recent daily swing or fractal points and may go back to absolute highs or lows on weekly or monthly data. This is lazy, as no consideration is given to whether the levels are important in relationship to other more distant turning points. It is also easy to forget these points if day trading on a lower time frame chart, as they are invisible. These levels are often just labels amongst lots of other levels. Which ones are the most important can be lost. So this is the explanation of peak expansion. It measures the range of a swing point or fractal. A swing point or fractal is a 5-bar pattern, and the middle bar of 5 must be the highest or lowest point. The range of the pattern is then compared to the moving average of all the previous swing patterns over the last 1,000 bars, or the length of the history. It then compares that and must be a certain user-defined criteria above that average for the peak point to move or the support or resistance to move. And I recommend that it needs to be at least 30% higher than the average. Peak energy is exactly the same principle, except for it looks at the volume that was created, and so the volume has to be 30% higher, and this means that energy levels move less frequently than the expansions. Used on active equalized daily continuation, the higher the time frame, the more important the support or resistance. Daily levels are red, are for reference when in a position. The use of Heikin-Ashi charts provides hidden daily levels, and they are pink. Positions can only be taken based on support and resistance levels and can be any pattern. Monthly levels or zones of levels can be traded with limit orders, and if you're day trading, half-day levels or zones can be traded with limit orders as well. So we're just going to look at a couple of charts. So Peak expansion, just put the weekly, which are always the black lines, and the monthly, which are the blue lines, and this tells us the major support and resistance. The higher the time frame and the longer between changes, the greater significance. So monthly is the most important one that we have, and if it doesn't change for a very long time, then that gives it more power. Zones of different levels of a weekly and monthly at the same point have the most power. So if we have a weekly and a monthly together or very close together, that creates what I call a very powerful zone of support and resistance. And here the monthly joined the weekly, and then we made the top. The use of active equalized continuations means that you often have levels the market does not. The market and commentaries are fixated on the absolute high on this chart, but it was not a major level. The critical weekly and monthly was lower and was not seen as important to others. So the market went up to what I had as a very, very powerful level. Market didn't know it was there, and that was the top. Just showing the difference here with a normal continuation chart, and it wasn't, the point wasn't connected to support and resistance at all. So cannot underestimate how important using an equalized contract is. This is just an example from what we see sometimes on commentaries, but this time I've put the study on there as well. So this uses my time average bands, has a pattern which is bullwhip or bear cage, and when we get a signal and it's at a weekly or a monthly support, that is always actionable, and I would say that people should be getting long. Just going to do a little bit on divergence and UFO on pops. Nearly all trends diverge, and incorrect application leads to premature exits. Also, even worse, it can make you trade against the trend, and the trend is your friend. Divergence is only a warning unless it happens at support or resistance. So UFO and pops. For UFO, price is making a 9-bar high, RSI making a 3-bar low, and for pops the other way around, so a 9-bar low, 3-bar high. Just use the normal 9-period RSI. I don't care what the value of the RSI is, because this also allows for what I call a divergence as a continuation pattern. So a UFO signal with that blue arrow, as we see quite often, at peak points, so this was a weekly and a monthly zone of resistance, is actionable as a short trade. The first signal on the left hand side, it's not at support and resistance, so it would just be a warning. If we had a long position, we could consider taking some partial profits, but we would not get short. The second signal, the trend is already down, we break weekly support, and so this is what I call divergence as a continuation. Here is another UFO at that 10-year level that was hidden at monthly resistance, and again note that we had a sell as a continuation that broke weekly support. Finally, we can use the same principle on intraday charts, but it only uses peak expansion when I show that, and I normally show a 60-minute chart, but it could be anything, and the peak points are 120, 240, 360 and 720, and normally I just highlight what I think is the most important, which is the 720 or the red line. Okay, thank you.